Did you know that the average investor underperformed the market by nearly 5% during volatile periods? That's not just a small gap, that's the difference between growing your wealth and barely keeping up with inflation. Why is that? Think about it. We have endless financial experts telling us to just buy and hold. We have decades of data showing that over the long run, the market will work itself out and deliver that sweet 7 to 10% annual return. And yet, study after study shows that real investors, actual people with retirement accounts and brokerage accounts, consistently underperform the very indexes they're trying to beat. Here's something even more puzzling. Consider this: even investors who had the chance to get in on Apple, Amazon, or Google at the beginning of their public journeys, companies that created generational wealth, most couldn't hold on long enough to capture those massive gains. The data from investment firms shows that the average holding period for these home run stocks was less than 2 years, missing out on 90% or more of those potential returns. So, what's going on here? Is everyone just bad at math, or are we all financial masochists who enjoy leaving money on the table? I'm not here today to share technical analysis with you or to push some complex financial strategy. Instead, I want to provide some unique value, a timeless lesson about the psychology of investors and why it's so incredibly difficult to stay the course. Today, we're diving into how our evolutionary biology, the ancient programming in our brains that kept our ancestors alive for thousands of years, actually works against us when it comes to investing. The fascinating field of evolutionary psychology has uncovered how our Stone Age brains struggle with modern financial markets. Stay with me through this video, and I promise you gain knowledge that will serve you not just through this market cycle, but for decades to come. This isn't about just timing the market, it's about understanding your own psychological reactions to it. So, let's talk about what happens in your brain when you see your portfolio dropping rapidly during market volatility. Those price fluctuations, especially in growth stocks, don't just make you financially uncomfortable, they actually trigger your brain's threat detection system. There's a small almond shaped region in your brain called the amygdala. It's one of the most primitive parts of our brain, and it's responsible for detecting danger. When you see your investments dropping by 5, 10, or 20%, your amygdala responds to those market drops in almost exactly the same way it would respond if you were physically threatened. This reaction made perfect sense for our ancestors. If you're a hunter gatherer and you lose your food stores, that's a legitimate survival threat. But when you're an investor in 2025, looking at temporary market fluctuations, that's the same biological reactions makes it extremely difficult to maintain rational thinking. Studies using functional MRI scans have shown that experiencing financial loss activates many of the same neural circuits as physical pain. This is why market downturns feel so viscerally uncomfortable. It's not just disappointment, it's a biological stress response. This response floods your system with cortisol, the stress hormone, which actually impairs your peripheral cortex, the region responsible for logical thinking and long term planning. So, precisely at the moment when you need to be thinking clearly and rationally about your investments, your biology is working against you. The second major challenge we face as investors involves our relationship with time. Successful investing typically requires patience, the ability to delay gratification, be calm, and think in terms of years or decades rather than days or weeks. But delayed gratification battles directly against our evolutionary wiring. Our ancestors evolved in environments where immediate rewards were essentially for survival. If you found food, you ate it right away. Waiting meant potentially going hungry or missing opportunities. Think about it. Through 99% of human history, saving for the future wasn't really a concept. There were no refrigerators, no banks, and certainly no retirement accounts. The idea of sacrificing immediate consumption for a payoff decades into the future is completely foreign to our evolutionary programming. Modern investing requires exactly the opposite behavior: the ability to think long term and resist the urge for immediate gratification. This is why so many of us struggle with the concepts like dollar cost averaging or holding through the market downturns. Our biology is literally fighting against our investment strategy. This also explains why we're constantly drawn to check our portfolios, look at financial news, and make frequent adjustments. Our brains are wired for immediate feedback loops, not for strategies that might take decades to fully play out. And here's something fascinating about why investors struggle to hold on to great investments like Apple, Amazon for the long term. It's not just about being impatient, it's also about lost versions of their gains. Once we're up 30% or 50% on a stock, our primitive brains start screaming, lock in those gains before they disappear. We begin wrestling with the fear of losing what we already gained, even if rationally, analysis suggests further growth ahead. There's also a psychological burden of opportunity cost when you're holding on to one stock. You're constantly bombarded with stories about other investments that are currently performing better. Your ancient brain interprets this as a potential threat. You might be missing out on the resources elsewhere. This FOMO, fears of missing out, is just another manifestation of our Stone Age programming. And let's be honest, our modern society has only intensified these evolutionary tendencies. We live in an instant gratification, dopamine driven world where everything from social media likes to Amazon same day delivery has rewired our brains to expect immediate rewards. These constant streams of notifications, 24/7 financial news, and trading apps that make buying and selling as easy as swiping right, they're all designed to exploit these ancient part of our brain. Technology has effectively supercharged our evolutionary vulnerabilities when it comes to investing. The third evolutionary challenge we face involves our social nature. Humans evolved as a social creatures who survive by staying with the group. Being rejected by your tribe wasn't just uncomfortable, it could be a death sentence in a prehistoric times. This social programming creates what behavioral economists call herding behavior in markets. When everyone else is buying during market peaks, going against the crowd triggers deep evolutionary discomfort. Similarly, where everyone is panic selling, our instinct to follow the herd often overwhelms our rational understanding of a company's long term value. Just think about any major market bubble in history, the dot com boom, the housing bubble before 2008, or even the crypto craze. At the peak of these manias, rational analysis was drowned out by social proof. The few investors who warned about overvaluation were ignored or even ridiculed because the herd was charging forward. This social validation bias works both ways. During market panics, like we saw in March 2020 when the pandemic hit, even investors who understood the market would eventually recover felt the powerful pull to sell alongside everybody else. Going against the crowd isn't just intellectually challenging, it triggers deep evolutionary discomfort. It activates the same brain regions associated with physical pain and social rejection. This is why contrarian investing, while often profitable, is psychologically difficult for most people to maintain. The final evolutionary challenge we need to understand involves the contagious nature of fear. Our brains evolved to prioritize and rapidly spread fear signals. These mechanisms helped ancient humans groups respond quickly to threats. If one person spotted a predator, the whole tribe needed to react immediately. In modern investing, this means fear spreads through the market much faster than optimism, creating the downward spiral and panic selling that characterize the market crashes. There's a reason market often take the stairs up but the elevator down. Fear propagates much more quickly than confidence. Financial news media unwittingly exploits this bias. Alarming headlines about market crashes grab attention precisely because they trigger our fear response. Your brain is literally designed to pay more attention to potentially more threats than a positive information. This asymmetry is hardwired into us. Studies in behavioral finance have shown that investors typically feel the pain of losses about twice as intensely as the pleasure of equivalent gains. This loss aversion is direct product of our evolutionary past, where losses like food, shelter, or safety could be fatal while missing out on gains was merely a missed opportunity. The result is that during period of market volatility, the contagion of fear can drive markets' behavior far more than the underlying economic realities. This creates both risks for the reactive investors and opportunities for those who can maintain rationality. So what does this leave us? Are we doomed to be forever sabotaged by our Stone Age brain in a digital market? I don't think so. The first and most powerful step is awareness. Understanding these biological reactions can help you recognize when they're happening. Here are three practical strategies you can implement. First, create systems that protect you from yourself. Automatic investing, predetermined buy and sell rules, or working with a trusted advisors can all help overcome these biological impulses. When you automate your investment process, you remove the emotional component. Second, intentionally limit your exposure to financial news during volatile period. Remember, media companies profit from your fear and anxiety. Checking your portfolio less frequently, perhaps weekly or monthly instead of daily, can help reduce the emotional impact of volatility. Finally, reframe how you think about market drops. Train yourself to see them as potential opportunities rather than threats. Warren Buffett famously said to be fearful when others are greedy and to be greedy when others are fearful. This isn't just a clever contrarianism, it's a recognition of how our evolutionary biases create market inefficiencies. Understanding the evolutionary psychology behind investment behavior doesn't just make you a better investor, it helps you become more self aware in all areas of decision making. These same biological impulses affects everything from how we handle career decisions to how we approach relationships. If you found this helpful and easy to understand during this market downturn, please hit that like button and subscribe for more content at the intersection of finance and psychology. Drop a comment sharing which of these evolutionary challenges resonates most with you. I'd love to hear your thoughts. Until next time, remember, your ancient brain helped your ancestors survive, but understanding its limitation might just help your portfolio thrive. Thanks for watching and see you next time.